banks and crypto have always been enemies. But their battles used to happen quietly, in regulatory filings, in congressional hearings, in legal briefs that nobody outside of Washington ever read. That's changed. The fight is completely in the open now, and the stakes have never been higher. This isn't the old argument about whether crypto is legal. That battle is mostly settled. This one is about something far more specific, and far more dangerous for the banking industry. It's about whether crypto can pay interest. And that is a fight banks absolutely cannot afford to lose. JP Morgan, the American Bankers Association, Coinbase, and Circle are all at war over a single loophole in a piece of legislation called the Genius Act. This was the law designed to bring stability and legitimacy to stablecoins. But in trying to contain crypto, it accidentally opened a new battlefield, one worth trillions of dollars. Welcome to Web3 verse. Let's get into it. To understand what's happening, we need to start with the Genius Act itself. The law was designed to end the regulatory chaos that had surrounded stablecoins for years. No more legal gray areas. No more exchanges operating offshore to avoid scrutiny. No more questions about whether stablecoin issuers were running unregulated shadow banks. The legislation brought major issuers like Circle and Paxos inside the federal regulatory framework with clear, enforceable rules. The centerpiece of those rules is a strict one-to-one reserve requirement. For every dollar-pegged stablecoin in circulation, there must be an actual dollar or a short-term treasury bill held in a segregated account. No lending that collateral out. No fractional reserve games. Full liquidity at all times. It was a direct response to algorithmic stablecoin collapses that had wiped out billions in value and shaken confidence across the entire industry. But the banking industry wasn't just interested in safety. They wanted something else built into this law. And they got it. The Genius Act explicitly prohibits stablecoin issuers from paying interest directly to holders. The whole point was to draw a hard line. Stablecoins are payment tools, not investment products. They should move money, not compete with savings accounts. The banks thought they had won. They hadn't thought it all the way through. Here's where it gets interesting. The interest ban applies to stablecoin issuers, companies like Circle, Ripple, and PayPal. But the law says nothing about stablecoin distributors. There is no language in the Genius Act preventing third-party intermediaries from taking the revenue generated by those treasury reserves and passing it along to users. And who are those third-party intermediaries? Crypto exchanges. The platforms where most people actually buy and hold stablecoins. So while Circle can't pay you interest on USDC, Coinbase absolutely can offer you rewards or loyalty incentives funded by that same treasury yield. Crypto exchanges spotted this immediately and started offering annual percentage yields of 4 to 5% on stablecoin holdings. Banks called it a loophole. Crypto called it innovation. Either way, it became the new front line in the war between traditional finance and the crypto industry. Let's trace exactly how the money flows because it matters. You put $100 into a crypto exchange and buy USDC. Circle, the issuer, takes that $100 and purchases short-term treasury bills yielding around 5%. That's the risk-free rate the US government pays on short-term debt. Circle doesn't keep all of that yield for itself. They have revenue-sharing agreements with the exchanges that list their stablecoin. So Circle pays Coinbase a distribution fee sourced from that treasury yield. Coinbase then passes roughly 4.5% of that back to you as rewards for holding USDC on their platform. From a user perspective, this looks and functions exactly like a high-yield savings account. You see 4.5% accruing daily. You can move the money instantly. It has the liquidity of a checking account with returns closer to a certificate of deposit. The only thing missing is FDIC insurance. Banks look at this and call it interest by another name. Crypto insists it's activity-based compensation for network participation and liquidity provision. To a regulator, it might look like a marketing incentive. To the user watching their balance grow every day, it looks like exactly what it is. And here's why banks are panicking. Traditional banks pay around 0.01% on checking accounts. Maybe 0.5% on savings if you're lucky. Stablecoins are offering 4.5%. Banks cannot compete on price because of their cost structures. Branch networks, compliance departments, deposit insurance, legacy technology. So instead of competing, they're lobbying to eliminate the competition entirely. Now, the banks aren't just arguing about their own profits. They're making a broader macroeconomic case, and it's worth taking seriously. The core concern is called deposit substitution. Traditional banks rely on what economists call sleepy deposits. Checking accounts paying almost nothing that customers leave sitting there out of habit. Banks use these cheap deposits as funding to make mortgages and small business loans. The spread between what they pay depositors and what they earn on loans is the foundation of their entire business model. If customers start moving their money to stablecoins offering much higher yields, banks lose that cheap funding base. When funding costs rise, lending capacity shrinks. Research modeled by a Federal Reserve Board economist suggests that for every dollar that leaves a bank deposit and moves into a stablecoin, bank lending could drop by significantly more than $1 due to the money multiplier effect. In a high adoption scenario, the total supply of credit in the US economy could contract by hundreds of billions to over $1 trillion. The concern goes deeper. When you deposit money in a traditional bank, that bank lends out most of it, which gets deposited somewhere else, which gets lent out again. Your initial deposit creates multiple times its value in credit across the broader economy. But when money sits in a stablecoin backed by treasury bills, it goes nowhere productive. It finances government debt instead of mortgages and small business loans. The Independent Community Bankers of America argues that trillions in transaction deposits are at risk of migrating to stablecoins. Their pitch is that every dollar that moves from a community bank to a stablecoin is a loan that doesn't get made, a small business that doesn't get funded, a local job that doesn't get created. Is this partly self-interested bank propaganda? Yes, absolutely. But is there real economic substance to it? Quite possibly. The crypto industry has strong counterarguments, and they're worth hearing. The case made by Coinbase and others is direct. Banks have enjoyed a government-backed monopoly on low-risk yield for decades. They earn the full treasury rate on your deposits, pay you a tiny fraction of it back, and quietly pocket the difference. That isn't competition, it's a structural advantage embedded in the regulatory framework. Stablecoins simply close that gap by passing the actual treasury rate through to the end user. From this perspective, the banks aren't protecting the financial system. They're protecting a decades-old spread that benefits them at the expense of ordinary savers. Circle has framed this as a question of dollar dominance globally. If the US bans stablecoin yield domestically, the market doesn't disappear. It moves offshore. European platforms operating under different regulations can still offer yield. Tether, already the largest stablecoin by market cap, operates entirely outside US jurisdiction. If American consumers can't access treasury rates on their digital dollars at home, they'll find ways to access them elsewhere, through less transparent, less regulated products. That outcome would actively undermine the dollar's position in the global digital currency landscape. The consumer argument is the simplest and probably the most politically potent of all. Why should access to the risk-free treasury rate be restricted to institutions and wealthy investors? Banks earn that rate on your money every day and keep most of it. Stablecoins pass it through to you. What economic justification exists for preventing ordinary people from accessing what the government actually pays on short-term debt? Congress tried to resolve all of this with the Clarity Act, which would have explicitly banned exchanges from paying yield purely for holding a stablecoin. Coinbase read the legislation and walked away. The Senate Banking Committee canceled the vote. The Genius Act solved the safety problem but created a competition problem. The Clarity Act proved that neither side is willing to give ground. The fundamental question hanging over all of this is about the future shape of the American financial system. Does it stay bank-centric, where deposits fund private credit and local lending? Or does it shift toward a model where digital dollars back government debt and banks have to compete for customers on equal terms like everyone else? That question doesn't have an answer yet, but it will. And the answer could reshape how money works in this country for a generation. Stay with Web3 Verse. We'll be tracking this every step of the way.